So, the third variance is variable production overhead variance. Now, let us understand how this variance arises. What is the reason? Poor planning is one of the reasons that you are not in a position to control your variable overhead. So, let us do the mapping of variable overhead, then take up a numerical and try to understand it properly. This is composed of variable overhead. I write in short: variable overhead, expenditure variance, or it is also called spending variance, and variable overhead efficiency variance. Right. So, we are going to write the corresponding formula. The corresponding formula is given here. It is standard variable overhead for production minus budgeted overhead for actual hour. AH I write for actual hour. We start from here the variable overhead costing. So, variable overhead variance can be bifurcated through a diagram into two parts. One is efficiency variance, another is spending variance or expenditure variance. So, let us make the diagram. Variable overhead total variance, this is bifurcated into efficiency and expenditure. Expenditure is also known as spending variance. So, the formula for the corresponding variable overhead efficiency variance are following. This is standard variable overhead for production minus budgeted overhead for actual hour. Right? In case of expenditure or spending variance for variable overhead, the formula becomes budgeted variable overhead for actual hours minus actual hour into actual rate. So, this is the position of variable overhead variance, which is broken into two parts. Let us take one numerical question and try to understand how this is done. So, question number 3, the details of G Enterprises. The detail is actual output 9,000 units. Direct wages paid is 1,10,000 hours at rupees 22 per hour, out of which 5,000 hours are idle. Very important. Your standard hour is 10 hours per unit. You have been provided other details also. So, other details are labor efficiency variance is given. You are also provided with standard variable overhead and actual variable overhead. So, let me note down. It is provided rupees 3,75,000 adverse. Standard variable overhead is rupees 150 per unit and actual variable overhead at rupees 16 lakh. So, these inputs are provided. So, how we will be proceeding? We are creating working note, which is the basic computation. So, we do the working note. In case of working note, you notice you have been provided actual output. How much? 9,000 units. You are also provided idle hour. How much? 5,000 hours. Your production time, which is actual. This is also provided 1,05,000 hour. Now, standard hour for actual production. This is to be found out. So, standard hour for actual production. You see, you have 10 hour per unit for 9,000 units. That means 90,000 hours is available to you. Further, you notice labor efficiency variance is given. Right? I can write it like this. I can write it like standard rate into standard hour minus actual hour. So, this is given at 3,75,000. Adverse, the standard rate is to be found out. Standard hour is 90,000 minus 1,05,000. So, we have an equation like this. We have to find out for standard rate. So, standard rate on the solution becomes rupees 25 if you solve the equation. Further, you are also provided with standard variable overhead rate. You are also provided with standard variable overhead at rupees 150 per unit, standard hours at 10 hour per unit, and standard variable overhead rate per hour at rupees 150 divided by 10 hour, or it is rupees 15. So with this input, now we are going to calculate the relevant points relating to variable overhead. Therefore, I am going to rub the board and give the solution to you. Now, let us do the computations. Idle time variance. This is standard rate per hour into actual idle hours. If you see, this is rupees 25 we have got, and actual hours is 5,000 hours. So this becomes rupees 1,25,000 adverse. The first part of the solution. The second part is total variable overhead variance. This is rupees 15 into 10 hour into 9,000 units minus 16 lakh. What is 16 lakh? This is the actual cost. So if you solve the equation, this becomes rupees 13,50,000 minus 16 lakh. This works out to rupees 2,50,000 adverse. So this is the second point in the question. Now let us work on the third point, which is variable overhead expenditure variance. So what is expenditure variance? It is the spending variance. So I am going to solve this rupees 15 multiplied with respect to 1,05,000 hours minus rupees 16 lakh, which is again the actual value, a combination of the related actual hour and actual rate. So if you solve it, this comes at rupees 25,000 adverse. The last part relates to variable overhead efficiency variance. So efficiency variance is basically standard variable overhead for output minus budgeted overhead for actual hour. So I can do it like this. I can create one more formula and say standard rate per hour multiplied with standard hour for actual output minus actual hours worked. So 15 rupees is standard rate per hour multiplied with 90,000 minus 1,05,000. So if you solve it, this becomes rupees 2,25,000 adverse. So friend, this is the solution of variable overhead